Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson.
Financial leverage ratios. Financial leverage ratios are important indicators of a company's financial health and performance. They measure how much debt a company uses to finance its operations and growth, and how well it can cover its interest payments and other obligations. Financial leverage ratios can help investors, creditors, and analysts assess the risk and return potential of a company. Some of the most common financial leverage ratios are: debt-to-equity ratio. This ratio compares the total amount of debt a company has to its shareholders' equity. It shows how much of the company's assets are financed by debt versus equity. A higher debt-to-equity ratio means a higher financial leverage and a higher risk of default. A lower debt-to-equity ratio means a lower financial leverage and a lower risk of default. Debt-to-assets ratio. This ratio compares the total amount of debt a company has to its total assets. It shows how much of the company's assets are financed by debt versus other sources. A higher debt-to-assets ratio means a higher financial leverage and a lower solvency. A lower debt-to-assets ratio means a lower financial leverage and a higher solvency. Interest coverage ratio. This ratio compares the earnings before interest and taxes, EBIT, of a company to its interest expenses. It shows how easily a company can pay its interest charges from its operating income. A higher interest coverage ratio means a higher ability to service debt and a lower risk of default. A lower interest coverage ratio means a lower ability to service debt and a higher risk of default. Financial leverage ratios can vary depending on the industry, business model, and stage of development of a company. Therefore, it is important to compare them with industry averages and historical trends to get a better understanding of a company's financial position and performance.